All right. Fortunately, I caught myself. I thought I was recording earlier and I wasn't. And fortunately, I didn't get too far down the road. But in this case, we're again talking about analyzing and recording transactions that affect owner's equity. We're kind of following up like in the same pattern we did with chapter 2 with owner's equity. And remember, think about owner's equity. What are the various accounts under owner's equity? Well, we have the capital account, whatever the name of the proprietor is, their name and capital, for when they put money into the business, the capital account. We have drawing, owner's name and drawing, when they pull money out of the business. Remember, they're a sole proprietor. They can do these things. They can move money back and forth between their own personal account and their business account. They have to pay themselves because they're like the only employee because it's the sole proprietor. They don't have any employees. They are it. So they got to pull money out of the business to pay themselves to pay their bills for their house and their car and their food and all that stuff because their job is this company. So don't think like, well, how come they're taking money out of the business? Well, they got to pay themselves. They're working for something. Well, what else affects owner's equity? Well, when they sell stuff like revenue or sales, they're increasing the value of their business. When they pay for day-to-day operating expenses to keep their business going, they are recording an expense, and that'll be decreasing the value of their business or a decrease to owner's equity. We're going to be analyze and record sales and receipt of cash on accounts. We're going to talk about cash sales. We're going to talk about selling stuff on account, and we're going to talk about receiving cash on an account for payment. So we step back and think about those three things, actually the three questions about which accounts are affected, are they increased or decreased, are they debited or credited, all right? And we're going to go through the 4-step process of what's the date, what's the debit, what's the credit, what's the source document as we enter these things in. Now remember, no matter how things, I'll just say this again, no matter how technical things get, we can always go back to our T accounts and just scribble them on a piece of paper and go, okay, what's going on here? Analyze, step back, what's happening? Okay. And again, the other thing too is this is a very manual, simple, we're learning accounting theory through this manual process, understanding that in reality, we have these big electronic accounting systems, or even a simple one like QuickBooks, which actually has like the electronic version of like these multi-column journals. They're just electronic. All right. And there's also the importance of having source documents in case you get audited or somebody's questioning what you did. So even like a calculator tape might be helpful in using as a source document. All right. So here we go. We are going to dive into some transactions on this. Receive cash from sales. Receive cash from sales, $1,100, calculator tape number 10. So maybe during the day, we received 3 payments from people that totaled $1,100 and we added them up. Okay, we probably should have had like sales receipts for that, but whatever. Here we go. First of all, we have cash. It's debited. We're increasing cash. It's an asset. We increase it with a debit on the left side. What are we crediting? Sales. Remember, it's on the right side of the accounting equation. Assets equals liabilities plus equity. Sales is an increase to equity. So we're increasing sales with a credit. And we're increasing equity in the process because sales is an account under owner's equity. What does that look like on the multi-column journal? Our 4-step process. Write the date in the date column, the 10th. Again, we don't have to say Jan period because it was already listed up above there. All right. Write the debit amount in the cash debit column. So conveniently, we have a special column for cash. I move my face out of the way there. My box is way too big here. There we go. I didn't say my head was too big. Record the credit amount in the sales credit column and place a check mark in the account title column. Okay, why do we do that? Well, because our special columns for sales and cash took care of this transaction. We're not entering any account title in that column because there's none to enter. It's already in the special columns over there on the right. And then also important that we note that we enter in a check mark into the post reference column. We're going to get into this in chapter 4. We put that there because there's nothing to post in the general debit or credit columns. And later on, when we say posting, we're actually going to be dropping the activity from the multi-column journal into accounts like T accounts. Write the source document number in the document number column. In this case, T10 for tape 10. And that is step 4. Okay, receive cash from sales. And again, we're being, oh my goodness, we're being very repetitious in this learning. Just understand that, every month you kind of make the same transactions. Same time every month, you kind of make the same transactions. Maybe once in a while you make seasonal transactions or annual transactions, but most businesses run cyclical, like a cycle every month that's very similar in operation. There's some exceptions to that, like inventory and things like that. Sold services on account to Main Street Services. Okay, remember when we say on account, we use that for both buying stuff and selling stuff. And this is where it gets confusing. Like, okay, well, whose account is it to? I'm selling it on account. I'm selling something, right? And somebody, because I'm selling something, rather than paying cash, they're going to owe me later. They owe me. Now, when they owe me, what do we call that? When I owe them, what do we call that? We should be very conversant right now in understanding the terminology around that. Sales invoice number 1. We sold something. What are our accounts affected? Accounts receivable, Main Street Services, $500. Okay. We increased accounts receivable. People owe us money. They owe us. That is an asset. We're going to get some money later. That affects my what I own. I own this account that people owe me money. Sometimes people even sell their accounts receivable to other people for money. I'm not going to get into that. We increase an asset with a debit. We increase sales, which is an account under owner's equity. We increase that with a credit. All right, no cash changed hands. We just gave them a sales invoice. They walked out the door with their stuff. In this case, some web service. I guess that stuff. It's intangible. We increase the asset. They will pay us later. On the multi-column journal, we enter in the date, the 12th. Again, the goal is for your multi-column journal to be chronological in date order. We record the debit in the general debit column, accounts receivable, increasing the asset, Main Street Services. Now, similar to accounts payable, most businesses have one big account called accounts receivable, and they have what's called a subledger, or a list of all the customers in that account and the activity for each one of those customers. It's like at the Marcus Whitman Hotel, for example, I kept a subledger of all of the people that we did banquet service from, because we would have the day of the event and then they would pay us later in 30 days. So in this case, I kept a manual subledger. I had one big account called accounts receivable, kept a subledger of all of the companies that owed us money. $500. Right, the credit amount in the sales credit column, because we sold something. So over there we have a credit of $500 to sales. And again, at the end of every transaction that we journalize, debits equal credits, assets equals liabilities plus owner's equity. So our debits were 500, our credits were 500. We increased an asset for 500. We increased an owner's equity for 500. Again, when you play Monopoly here shortly, or maybe you already have, I don't know what day I'm on, you're going to have to prove every time that those things balance. Balancing is key. Write the source document in the document number columns. That's sales invoice number 1. We're going to call that S1. Right there. Paid cash for an expense. Okay, think about, what? Again, those 3 questions again. I got to cheat and pull up my notes here. Which accounts are affected? Well, obviously cash and some sort of expense, which we're going to leave unnamed for now. Are they increased or decreased? Well, we paid cash, we decreased cash. And if we paid for an expense, we increased an expense. We have more expense. Are they debited or credited? Well, let's take a look. Paid cash for communications bill, including cell phone, internet service, $80, check number 4. Communications expense. And again, some companies may track their cell phone, they keep them separate. Who knows? You decide when you create your chart of accounts how detailed you want stuff to be. What do you want to track? What's important to you? Some of it you can just put into miscellaneous. I do this with our lake cabin, like, okay, family, what do we want to track as far as our annual expenses every year and what's just kind of stuff that comes up? All right. We increase an expense with a debit. Now, communications expense is under owner's equity. We increase owner's equity with a credit. Well, communications expense is a reduction in owner's equity, but we increase an expense with a debit. It ultimately will decrease owner's equity. That may be one of the more challenging concepts right now as we go through these debits, credits, increases, decrease. Cash went out the door. We decrease cash with a credit. And it looks like this. Write the date in the date column. We debit the communications expense, $80. We write in the account title because we're putting $80 in the general debit column. Every time we put anything in debit or credit for general, we have to write in the account title in our multi-column journal. Then, of course, we're crediting cash for $80. We already have a special account for that. Then we write the source document, check 4, in our source document column. And here's another one, paid cash for an expense for equipment rental expense, increase, cash, decrease. Again, we're increasing or debiting an expense, which conversely is a reduction in owner's equity. Anytime we debit owner's equity, we're reducing owner's equity, but we're increasing expense. Got to stick with that. All right. And here's how it looks in our ledger. Write the date in the column, 15. General debit, $400. We have to write the account number, the name of the title, account title in there, $400. Write the credit amount in the cash credit column. Write the source document number in the document number column, which is C5. You know, here you got to pause, just go, if we had to do accounting like this all the time, it would be very dreary business. Fortunately, we have software to help us do this. So just stay tuned for that. Just understand that software makes this so much easier. But again, we're learning accounting theory right now. Receive cash on account. Did we sell something? Well, not in this case, no. Did we buy something? No. Once again, our questions are, which accounts are affected? Pulling up my notes again. Which accounts are affected? Cash. And what's on account mean? If we're receiving cash from something on account, somebody owed us money. That is accounts receivable. Are they increased or decreased? Well, obviously cash is increased. What about accounts receivable? They owed us money, but now they owe us less. And accounts receivable is an asset. So if we're decreasing what they owe us, we're going to decrease an asset. So in this case, we have an increase in one asset, a decrease in another. We've been practicing this a lot lately. Are they debited or credited? Here we go. Cash is debited for $200. We increase cash. We increase an asset. Accounts receivable, Main Street Services. It also is an asset. We're decreasing an asset. And like I've asked the class several times, if our accounting equation assets equals liabilities plus owner's equity, if all the activity happened over on the left side on the asset side, what happened on the right side? Liabilities and equity. Nothing. Yes, nothing. Looks like this on our multi-column journal. Write the date in the date column. Write the debit amount in the cash debit column. Write the credit amount in the general credit column. And write the account title, accounts receivable, Main Street Services here. Source document is receipt number 2. Again, at the end of the day, debits equal credits, assets equals liabilities plus owner's equity. In this case, there was no change made to the assets because we had one increase and the other decrease, and no impact on the right side of the equation. But we do have more money in the business because a few days ago or weeks ago, we sold something. Paid cash to owner as withdrawal of equity. Once again, which accounts are affected? Paid cash means something went out the door, an asset decreased. What do they count as affected? Well, so-and-so's name drawing. And this gets where we get confused. Are they increased or decreased? Well, obviously our cash decreased. When we say, kind of like expenses, when we say the drawing account actually increased. Equity decreased because we increase equity with a credit. In this case, we're going to have a debit to a drawing account, but the drawing account is kind of like an opposite equity account. So we're actually going to increase a drawing account with a debit. Let's see what that looks like here. Paid cash to owner for withdrawal of equity $350. Again, the owner's paying himself. He earned some money. We're debiting Michael Delgado drawing for $350. We are increasing a drawing account, which has the effect of decreasing equity. The individual account itself, its increase side is the plus side. It's kind of, maybe even think of it as an exception to that. On the left side, the increase is assets, is debits. On the right side, we have liabilities and owner's equity or credits. We have this Michael Delgado drawing account, which is actually pulling money away from equity. And its increase side is actually a debit. It's on the right side of the accounting equation, though, isn't it? That gets confusing. And of course, we're decreasing cash for $350. On the multi-column journal, we write the date, the 16th. We record the debit amount in the general debit column, Michael Delgado drawing, because we don't have a special account for that. Now, if he was pulling money out of the business all the time, maybe he would have a special column for that. So $350 is debited. Cash, of course, is credited for $350. And we write in our source document C6. Okay. Which journal columns are used to record receiving cash from sales? Which journal columns? Pause the video. I'm not going to go back to the multi-column journal. You should be able to think. Are we using, I guess the question is, are we using any general debit or credit columns? Okay. What did you come up with? Well, we're debiting cash, we're crediting sales. We'd put a check mark in the account title column because if there's no account title to be entered, we covered it with our special columns. And we're putting a check mark also in that post-reference column, which we'll get into next chapter. Which journal columns used to record sales on account? Well, I hope you recognize that we do not have a special column for accounts receivable. So we're going to have a general debit, and we're going to enter accounts receivable in our account title area, and sales credit, which we have a special column for. Which journal columns used to record paying cash for an expense? Well, general debit, whatever the expense happens to be, plus a description in the account title area, and then cash credit, because cash is going out the door. Again, when we say cash, we mean green stuff or writing a check. I guess maybe we could possibly also be using a debit card because that's coming right out of our checking account for our business. A business might have a debit card, also might have a credit card. We'll get into that later. Which journal columns used to record receiving cash on account? Once again, we didn't sell anything. We're going to debit cash. We're going to credit accounts because they owed us money. Accounts receivable. We're going to reduce one asset, accounts receivable, increase an asset called cash. we're going to write accounts receivable, name of customer in our account title area. Which journal column is used to record paying cash to the owner as a withdrawal of equity? We just did this a moment ago. And again, I hope you can pause these and think, maybe go back and look at the various entries we've made. We're going to have a general debit to name of owner, comma, drawing. We increase that with a debit. It's a reduction of equity, money coming out of the business. And we're going to credit cash. We're going to reduce cash. So at the end of the day, we reduce an asset. We increase a drawing account, which is in turn a decrease to equity. All right, let's do some practice here. I'm going to pause this video in 1 second here. So let's go to MindTap to Working Papers 3.3. Work together, page 75. I'll change those scores, of course, later. All right. And we have a few working together things here to work through. Looks like we have 6 transactions related to owner's equity. And we're back to Norma Dirks with, I'm going to pin this again. Norma Dirks with her, I just wiped out the instructions. Good job, Reardon. Let's go back and read those again. We use check for C, receipt for R, sales invoice S, calculator tape T. CRST, can you remember that? I can. Okay. Those are all the previous transactions that we made in our work together area from our previous chapter 3.2. Now we're going to journalize these 6 transactions. Again, when we say journalize, we're talking we are putting them into a multi-column journal. All right, now I'm going to pin. Here we go. Maybe drag this down so I can see it well. All right, so here we go with our next entry. We're going to put the date in, the 12th. Paid cash for rent. Okay, chart of accounts, I'm assuming it's going to be something related to rent expense. Rent expense, there we go. All right, so rent, and again, if you start going off, it's going to be yelling at you there. Rent expense for how much? $650. And of course, credit cash. I kind of wiped out my, you guys know that cash is over here and this is sales. I don't have to go up and show you that, do I? There we go. Sales credit. I'm just trying to get some space here. Sales cash credit of $650. Next transaction, the 13th. Receive cash from sales. $2,500. Okay. Well, we're debiting cash over here from 2,500. Guess I don't have to do the 0.00. Again, that's an increase to cash, debit to cash. Credit over here to sales is not $25.99. And again, it's going to put the 0.00 in there for me for sales credit. I don't have, can I just put a check mark in there? How do you put a check mark in there? Did they say that in the instructions and I missed it? Now I'm stuck. Oh my goodness, I'm stuck. Okay, we're in trouble. Scroll up. What's the deal? I'm going to unpin that. They tell us what to do. So check, blah, blah, blah. Okay. I'm going to put in, I don't quite know what to do here, but we'll figure it out. I'll see what kind of a grade I get. How about that? So on the 13th, I don't really have anything to enter. Well, there's my check mark. Oh, yes. And I would put in my source document here, T13. You guys probably looked at that and you went, oh, Reardon, you just put a check mark in there. Okay. And on our post reference, we'd also put a check mark. We don't have to do that here. So here's our transaction for the 13th. This is live, by the way. I'm not going to go back and edit it. Transaction for the 14th, sold services on account to K-Spa. K-Spa. All right. Well, what are we debiting? Well, we're debiting. Let's go look at our chart of accounts here. Accounts receivable, K period SPA. Accounts, whoops, Reardon, comma. Accounts receivable, K period SPA. Now, again, if you mess up, it'll yell at you. We're debiting that using our date, number one. Number two, what do we debit? We debit accounts receivable, and we credit. Again, I don't have to show you the label, right? We know that that column right there is $480 sales credit. We sold services on account. We debited an asset called accounts receivable. We credited sales. Now here's, by the way, rent expense. I messed up, didn't I? Down back here, C4. Reardon, you missed that one. Source document here is S1. Next transaction on the 19th. We paid cash for electric bill. Well, what's our chart of accounts say? Utilities expense for like electricity. Okay. So we're going to debit an asset, utilities expense. We're going to debit that for $220. We paid cash. So we're going to credit cash, $220. And we're putting our source document C5. So again, date, debit, credit, source document. That's the pattern we've been using. 20th, received cash on account from K-Spa. All right. Did we sell anything? Well, a while ago we did, but not here. Did we buy anything? No. Somebody just walked in and paid us money. Can I copy and paste this? No, I can't. So my debit is going to be cash, following our routine here, $255. Our credit is going to be accounts receivable. And again, it's going to yell at you if you misspell something. We're reducing an asset called accounts receivable for $255. Again, if I scroll back up and look at my account headers, I'm doing a general credit for $255. What's my source document? R2. Finally, down here in 21, paid cash to owner as withdrawal of equity. Chart of accounts. What's my drawing account? Norma Dirks, comma, drawing. Norma Dirks, comma, drawing. Again, we increase a drawing account with a debit, which in turn is a reduction in owner's equity. So we're going to debit Norma Dirks for $1,500. We're going to credit cash, it's going out the door. We're reducing an asset by $1,500. We're increasing equity, we're increasing drawing by $1,500, which has the effect of decreasing with a debit equity. Source document C6. Okay, there is our work together piece. You'll now do the on your own in Working Papers 3.3, which is the only assignment for this particular section of the chapter. Let me know if you have any questions. Thanks for following along. Have a great day.